I think a lot of PE firms have raised their last fund because the LPs are getting a lot more diligent about where they put their money, and there's a lot more going at the top end and the lower end. So I think there'll be a considerable clean out of the middle market. But I think private equity firms will look different just because of the environment. The environment has been very kind for a long time. And now because you work in a very different environment, you have to be operationally focused. So I think firms that emerge that say, yes, we have to do operations and we have to be directed from day one. We have these playbooks and we know they're going to work. So from day one, we have value creation plans and we make sure they get executed.
I'm Felicia Shakiba, and this is LeaderBook AI, where we solve a business challenge in every episode. Private equity has had it easy for 40 years. Buy a company, load it with debt, let the market do the work, and collect the check. Lee McCabe, partner at Claymore Partners, says the reckoning is here, and most PE firms still haven't figured it out. Lee, welcome to the show. It's great to have you here.
Thank you. Good to be here.
I want to talk a little bit about you and where your journey began and how you're here today. So you started, or at least you went from Facebook to Alibaba and then now private equity. So tell me
Yeah.
a little bit about your journey and what made you cross over.
Look, I was all big tech. I was eBay early on in London, then Expedia in Asia Pacific and North America. Then I ran a few global verticals for Facebook, starting with their travel business, which was basically figure out how you make as much money as possible from the travel industry, all via advertising, but great business and just fun times at that company. Then I moved to Alibaba to run North America for Alibaba Group. And that really opened my eyes to PE because one of the jobs at Alibaba was pitching all the major North American brands to sell on Chinese platforms like Tmall, because that was by far the easiest entry into commerce in China and e-commerce in China. And more brands that I was meeting their boards and they were PE owned. And it really opened my eyes to the grasp that PE had across most industries. So that was one learning. And the other learning was how not digital private equity was. And coming from a digital background just struck me as crazy that, digital and digitization wouldn't be a major lever for private equity. You're buying all these good businesses with good bones, but old and boring businesses. And boring is not bad. Boring is a cash cow. Boring businesses make a lot of money, but a lot of them weren't being digitized and still aren't being digitized. So it just struck me as a massive opportunity. So I left Alibaba and spoke to quite a few PE firms and ended up joining one out of New York and was there for 5 years as an operating partner. And it just proved my kind of thesis that there's just so much digital opportunity in private equity. And then I launched my own business a year ago, Claymore Partners, and now I work with several PE firms working on their portfolios to find that digital value creation. And to be honest, it's not that hard. There's so much low hanging fruit in this. It's crazy.
And the specialty that you're talking about, is it digital, or is it like to digitize the organization, or is it marketing, or is it both?
It's both. So you have to fix the foundations. If I think when I was in PE, private equities had two routes that they'd go to, right? If they said, look, I've got this asset, it's a good asset, but it's not digital. The founder's not a digital guy, and we know there's a ton of opportunity here. They would have gone to a consultancy and paid way too much money for a project. And the consultant would have delivered a project, and then they would have said, thanks for the fees, good luck. Good luck hiring people, and good luck finding vendors to execute this, which is the hardest part of all this. Or they might have gone straight to a digital agency, and the digital agency wouldn't have taken the time to look at the strategy or the tech stack or the website or any of the foundational business elements. And they would typically jump straight to, look, we've analyzed Google, we've analyzed Meta. We think we know how to spend more. We think we know how to make you better. But, I think 99% of digital agencies are terrible. And that's a fool's errand because in most cases, the tech stack is broken and the company's not collecting enough data. So really, you haven't got enough data to guide you where to spend it well. This is just about doing the basics very well. So What I mean by that, here's the basics. First of all, you say, how does this company make money? And you may say, well, duh, shouldn't the company know that? But I never fail to be shocked when I speak to the leadership team and I say, well, how does your company make money? Just talk me through the KPIs and the business drivers. Talk me through the LTV. Talk me through the CAC. Talk me through that. Help me understand in metrics what this business looks like.
Yeah.
And digital agencies, I've worked with a lot, and I've been in some cases 2 years when they've been on a portfolio company for 2 years. And I've said to them, do you understand this business? You don't know the LTV or any of the business drivers. How can you be a great business partner if you don't understand the business? So you start off by doing the simple things like saying, mapping it out. Here's how this business makes money. And then you say, let's look at the customer journey, because that's fundamental. So I want to understand how you go from first point of contact with the customer to revenue realization. Like, how well do you push that customer through your business? What are all the touch points? What are all the conversion points before you actually make money? You have to understand that. And most companies don't take the time to map that out. So you say, okay, now I understand the business. I understand the customer journey. Let's look at the tech stack, because you should have a tech stack to do two things. You should have a tech stack to push that customer through your business as efficiently and effectively as possible. And you should also have a tech stack built on data to give you a business built on data. So everything should be tagged and tracked. And I've never come across any business that's had a best in class tech stack in place. So that there's always gaps there. And that's really the foundational element. If you fix the tech stack and you say, now you've got a business built on data, you can build BI on top of that and AI and give you more insight into your business that you've ever had. You can then look at the website and say, okay, now I understand the customer journey. I'm going to improve conversion rate optimization on the website. I'm going to make that a lot more effective for you and drive more business. And then the last part is the digital marketing. Because if you get the digital marketing last, when you've mapped everything out and you have all the data, digital marketing is the easiest part of it because it just becomes math. So that's how we think about it.
So, what kind of data are you expecting to see? What should executives be thinking about when it comes to like some foundational data that they should have, maybe about the customer journey or whether it be something else?
Well, ultimately, you want the data to tell a story and you want to map it. Let's say the customer journey. I want to understand where every customer comes from and how I'm bringing them into my business. And I want to understand what I've paid for that customer. Typically, you might have 10 channels, and some of them might be free channels. You're probably paying for most of them, but each one has a cost, and you should be managing those channels well. So I want to understand, what am I paying for a customer from each channel? How am I bringing them in? Okay, once I get them on my website, how do I convert them to actually pick up the phone, make a call, or fill out the web form? And then that starts to tell me the quality of that customer, and it allows me to kind of gauge the channels. Then once that customer's called, then what happens? Depending on your business, it might be a services business. Once that customer calls, how successful were we at setting up an actual appointment? It's sign of quality. Then after that appointment, how many people cancel? What was the cancellation rate? If the appointment went ahead, how many customers actually bought the product or bought the service? And then when they bought the service, what was the average order value of that service? So you can tell a very good story with metrics, and slowly you unpack that and say, okay, I can see this very clearly now. I've been spending on these three channels and they've been really ineffective for me. They bought in a lot of customers, but those customers were terrible. They didn't convert. The average order value was low. I'm making very little from those major channels, and I've been spending all my money on them. But there's two channels emerging that they're super effective because they're bringing good customers and converting them. Their average order value is double what I'm getting from elsewhere. Right, that's where I'm going to spend all my money going forward. So when I said build a business on data, there's no reason you can't do that very easy nowadays and see everything that's going on in your business and track that customer very precisely from first point of contact to when you make money from them. And depending on your business, if you're good, you make money the first time, hopefully you turn them into a recurring customer. And that's more metrics. What percentage of customers do I get a second transaction from and a third transaction? How do we do that? That should be free marketing, because once you've got the customer, it should be email and SMS and making sure you keep them and improving that average order value on the second. and third run. Yeah, building a business on data, every CEO, that's really the number one priority. If you build a business on data, you can manage it very easy. Gut feel goes out the window. You have a business built on metrics.
And it's interesting that you bring up the CEO role because in private equity, 70% of CEOs get fired before the exit. So is that a private equity problem? Is that a CEO problem? Is that a recruiting problem? Or is it a metrics problem that you're like the problem that you're seeing, which is, not enough CEOs are actually leveraging the data?
I think it's parts of everything you mentioned. Ultimately, it's a systemic problem. Because if 70% leave before the whole period is out, it's an issue. And it's probably not as high as 70 because some of them, when a P firm buys them, there's an agreement. You buy a firm, the founder's in place, and you both agree you're probably not the right guy to take this forward the next 5 years. And most of the time, the founder will say, "You're right. And I don't want to. I'm happy stepping into the chairman's role and bringing in a CEO." So it's probably not, look, it's still high. It's probably not quite as high as that. But I think it's a systemic issue because the pressures under a PE firm are much more than when you were a founder. The monthly meeting, the quarterly meeting, the annual review, the pressure is on growth. And it should be. I mean, this is a business. The PE firm is not buying you for the fun of it. The PE firm is buying you because you're an asset, you're an investment. And the PE firm has to answer to their LPs and predict what kind of return they're going to get. So if the CEO is not set up well to do that, or if the CEO is not the right guy to do that, yeah, they probably won't make the holding period. And I think it's a different kind of CEO that is built right for PE, and they absolutely have to be metrics driven because PE firms are metrics driven. PE firms are finance guys. So that brings home even more the importance of building your business built on data because you shouldn't ever get stuck for an answer. You should be able to tell clear stories about how you're going to grow this business, where the opportunity is, what's happening right now. Data also gives you transparency and gives you trust over time. So you're all looking at a single source of truth. You're all looking at the same metrics. That makes a business much easier to run. And it also makes a private equity held business much easier to run because you can share all those metrics with the PE firm and the board and have a clear picture.
And you're building a fund by starting with operational platform first. Is that right? Like why does that change everything? How does that evolve where we are today from where you're going?
Sure. Well, look, ultimately, yeah, Claymore, it's always been my vision it would become a fund. But I saw the opportunity to build it backwards and build it operations first, because that's the way private equity has to go. And private equity is kind of stuck right now. Returns are an all time low. They're sitting on 30,000 assets that they can't sell. The challenge is, well, the issue is if you look at history, P's had a pretty easy time because the market's been very favorable. Multiples have gone up over time. No matter what you did to the asset, it got re-rated every few years. So you were able to buy the multiple and exit for higher multiples 4 years later without touching that asset. Interest rates were low. That helps PE. And the S&P is a bellwether. The S&P has been doing great for a long time. That makes investors more bullish. That gives investors higher risk tolerance. It lets them invest in different asset classes. So it's been an easy ride. Now we're seeing with news every day, it's a lot harder because interest rates are not, we've left a time of free money. Multiples are not going up. Multiples are stagnant and in some cases declining. So PE firms realize now, they can't be just governors of a business. They have to be operators. You have to get into a business and define how you're going to create operational value and actually do it. And because P's had an easy time in the past, governance was the main thing they did. There was a few levers, they pulled on pricing, was always the go-to lever. And that really wasn't that hard. To do pricing well, you need an Excel spreadsheet and a few adults. And procurement was a go-to lever. And then really governance, monthly, quarterly, annual governance. And you did very well. Now the tide has turned. So you have to be operational and you have to go in from day one. You can't cross your fingers that the CEO is going to get it and it works out because a lot of the time they don't. That's why there's such a high exit rate. So I think that the tide is turning now, and P's starting to realize that we need a different set of tools, and we can't stand off and cross our fingers. We have to get in day one and put a very effective value creation plan together, and then make sure it's operationalized. So that's why I'm building an operation platform first. And everything I just talked about is drives a ton of value, especially if you go into companies that really haven't digitized. Again, all big companies that are cash cows and are great businesses and have great bones, but haven't realized the digital potential. And whatever you're going after nowadays, whether it's a consumer or a business, they're all digital. You're not going for business. You're not going to conferences anymore and making connections there and or sat on the phone doing cold calls every day. If you're in business, whatever product you're looking for, you're going to Google to search for it first. So you need to be found on Google. And consumer, I mean, we all know that. Whatever I look for now, if I look for a product, I go to Amazon first. If I look for a service, I go to Google first. So these businesses can be very successful if they master those channels because the intent is there and it's easy. If someone's got intent for your product, well, just make sure you show up in front of them. Just make sure you are there in that moment of intent and you stand a good chance of winning that business.
I want to zoom out and try and understand what is the moment that doesn't work? Because you've sit in a lot of rooms with digital agencies and clients and executive teams. What is the moment that you realize it's not going to work? Is it something like you see something that the CEO said or doesn't do, or what their goal is, or what their eye is on, or what they're moving towards, or what they're saying is not really actually what they're doing? Like, what are those red flags that you say this is not going to work?
When they can't answer fundamental questions about their business. Because, like we just talked about, there's no reason you can't do that now with data. So simple questions like, what's the most effective channel for you? Okay, what's the cost of user acquisition in that channel? What was the most successful channel for you last month? Okay, what's the LTV in that channel? Can you just give me a read of kind of your marketing now? You spent $1 million last month. Exactly what did you get back for that, and how did you get back? How did you get that back? And where are the areas for improvement in that spend? Within a business, again, if you haven't taken the time to build a business built on data, and there's no excuse for that nowadays, that's a red flag. With agencies, there should be only one question that you ask your agency, and it's how much money did you make me last month? That's it. Because these businesses, they're not paying agencies for the fun of it. And that's a fundamental issue with agencies because they don't class themselves as business partners. They think they're marketers and can happily talk about 200 Banty metrics that really don't matter. But at the end of the day, you're there to make more money for that business. And if you can't tell them how much money you've made them that month, yeah, that's a massive issue. And then for CEOs, I'm not sure there's any one red flag. If they don't know the numbers or they're not data driven, that's not great. But I think the standout CEOs think about business in a different way. So I'll give you an example of what I mean by that. And I think digital has kind of changed how you frame what business you're in. So in the past, let's take residential services. You might go out to a CEO who runs a roofing business, and you say, "What business are you in?" And the average ones will say, "I'm in charge of a roofing company." The ones who really get it will say, "I run a sales and marketing business," or "I run a lead generation business." And then if they say that, I think, you get it because that is your business, lead generation. And of course, the service has got to be good and the product's got to be good, or you won't get recurring customers. But if you master lead generation, if you master that funnel and that pipeline, and you're across the metrics, and you say, "Yeah, I can go into a new market and drive leads tomorrow because I've got a playbook and I know how to do that via digital." And if you know the numbers behind that, which is back to my earlier point of just mapping out how does this business make money? Because you'll get to a point where you say, "Look, I understand all the conversion rates and all the drivers. So I know if I can get a lead for $200 in this business, that's good business. That's going to be very profitable for me." And if they get to that point, their marketing budget should be bottomless because they just say, "I'll buy those leads at $200 all day long because it's a license to print money." And that's what data gives you. Data gives you that predictability and that insight on where to spend. So the CEOs who get that, who say, our lead generation business get it because they know today they may sell roofs, but really it's a lead generation business that sells roofs. If they master that, they can sell HVAC next week. They can sell flooring the week after. They can sell windows the week after that because you're hitting the same consumer every time.
And there's, correct me if I'm wrong, but there is probably a ramp up period where they have to do experimentation about, let's try this channel, let's see if it works, let's try that one. Is that, how long does that take? Or and is that the approach that you take? Or do you come with, oh, I already know what works? Like what is the starting point?
It's different by channel. So if you go through the major channels, typically when PE buys a company, the founder's been very heavy on brand. And that's been great. It's built their business. So heavy on TV and radio. And there's still a place for that. Brand building is very important. But that's it's a long-term game. But you absolutely should build a brand. But then you look at the digital channels, paid search, you can figure that out pretty quickly because you're getting a response. Once you start putting the keywords out there in your campaigns, you can see by the minute how many people are clicking on them, how many people are converting, and you can soon figure out, okay, that campaign is not working, that campaign's working, those set of keywords aren't working, it's working in that market, but not that market. You can test and learn pretty quickly in paid search. You can also burn a lot of money immediately if you really don't know what you're doing. So start slow, but start with low budgets, figure out what's working for you. And then when you get to that sweet point, which might be back to the $200 per lead, and you see predictability in that, you open the spigot. SEO is important, but again, that's long term, but it's kind of a hygiene factor. You should be investing in SEO and building that out. And then depending on the business, there's multiple channels. Direct mail is effective. You can't measure the results of that straight away, but there's a massive brand kicker in direct mail. At my last house, I received at least a week a direct mail from a window business. And I wasn't in market for windows, and I would bin the direct mail every week. But their branding works because if someone said to me, name a window company, I'd have named their brand, first of all. And whenever I decided I needed new windows, their brand would have been top of mind for me. So I would have gone to them first. So I think there are multiple ways to do this. A marketing mix, you are figuring this out every month because the macro changes, competition changes. And that's really the hardest part of marketing, figuring out your marketing mix, the balance between 20 different channels you could be on. And that's where you need a superstar to run marketing to figure that out and make sure that the data's there. And there should always be a test and learn budget because new channels are emerging all the time. Like it would have been TikTok several years ago. Yeah, as soon as that emerges, there's an opportunity. Start testing. See if you can make money on that new channel. If you can't, you can't. If you can, great. That's a new channel to add to the mix. AI right now, everyone's trying to figure out what to do in AI. I don't think there's great stories around that yet, simply because AI is a black box. If anyone tells you they know how to make you appear more in AI, they're lying because it's a black box. We can't see the signals. ChatGPT and Claude are not telling us what you have to do to show up. So everyone's kind of guessing this right now. And I think that the most widely believed story is look, get good at SEO, get really good at SEO. That will help you with AI. Once we start learning more about AI, we'll have the signals to tell you what to start doing. And that might be, look, right now you're focusing on keywords. The logical trajectory would be you focus on questions going forward as AI search starts to take a stronger hold. But like I said, that's a black box. You absolutely should be thinking about that right now. And everyone in your business should be on Claude or ChatGPT because it's changing fast and it's super good. Claude is amazing. I use it every day. It's just important that you've got your people using it and understanding the capability because they'll find new ways to use it every day.
So, actually, a really good point that you make because I've heard that there's a major difference around SEO and AI instead of just for web. What are the main differences that you're seeing? So, let's say I'm a business owner, I've been doing SEO for Google search or Bing or whatnot. And now AI has come about. What should I be doing differently?
Well, that's the question. Like I said, if somebody tells you they know what to do, they're lying because there's no signals. We don't get signals from ChatGPT or Claude yet to really know how you appear in those search results. SEO was different, right? And SEO, people learn the signals over time of how you got better in SEO, and you could prove that. So, how you improved in page rank in SEO, the main drivers you did were backlinks. And if you said, look, I'm going to spend time on backlinks and I've gone from having 10 backlinks to 1,000 backlinks, that makes your site seem more important. And you can see the correlation in SEO. So people said, okay, backlinks are going to be important in this. And there are a few other drivers that people tested over time. So SEO was an industry built on trying to game the system, right? It's trying to make your site seem more important than it might be in Google's eyes. But over time, people learned what worked and said, yes, I'm going to come in and blog posts work. So I'm going to focus on blog posts with the right keywords on your site. And if we do that, it works. And they could prove that. And they could prove, look, we're going to focus on backlinks. And you did that. And you can get the signal because you can see where you rank in SEO. So you can see all your work and you can see what it's done. It's not perfect, but you really know what to do to be good at SEO. You don't know what to do to appear in AI search. There are no signals there. Everyone's guessing right now. And I mean, the guesses are you look at it and go, oh, well, where's ChatGPT pulling most of its data from? And the most educated people look at this and go, look, it's using Reddit a lot for its data, and it's using LinkedIn a lot for its data, and it's using a lot of other random sites for its data. But we don't know exactly what it's using. We're still guessing at that. So then they might say, well, you post more on Reddit. And that might work, but we don't know. If someone posts a lot more on Reddit, you really can't measure if you're being exposed more in AI yet. So that's why I say you should think about this and start preparing and start testing and learning, but there's no signal. The best signal will be when AI has paid ads, just like Google did. And it has to have at some point because they're burning a lot of money and they have to monetize it. So when AI starts to introduce paid advertising, that's the easiest and the best signal because it will tell you, here's what you need to do. And that's the easiest because it's pay. You pay money. But then there'll be things you have to learn. Just like on Google, you had to learn about bidding strategies. It's not just the highest bidder wins. You have to learn about the quality of your site. You have to learn about campaign strategies. So I hope this channel will emerge, and it's blowing up now. But once they release paid advertising, yeah, it'll be massive.
So that's interesting because I think that a lot of people, I mean, if you go on YouTube, there's tons of videos. I always wonder if that's actually working or not working. And even if it is, if it's something that's different, it's like, am I supposed to create more questions on my website? Or, I'm thinking of it as well, like from a business owner standpoint. At the same time, like I do get clients finding me from their AI search. I don't know why.
Nobody does, and I've had lots of discussions with agencies, and it kills me because I break down the story. It's back to my point earlier. The only question you should ask your ad agency is, how much money did you make me last month? All these guys pitching they can help out with AI search. I simply say to them, okay, if I give you $100,000 this month, what can you make me? What will you turn that into if you invest in AI search? Like, oh yeah, can't tell you. Right. So what does that mean? What does that mean?
Oh boy.
You're guessing like this, like everybody else, and you're taking advantage of the AI hysteria, and everyone's jumping on AI, and you're taking those fees, but you can't guarantee anything, right?
Well, what does private equity look like in 10 years if it doesn't change?
Well, I think it will change. I think a lot of PE firms have raised their last fund because the LPs are getting a lot more diligent about where they put their money, and there's a lot more going at the top end and the lower end. So I think there'll be a considerable clean out of the middle market. But I think private equity firms will look different just because of the environment. The environment has been very kind for a long time. And now because you work in a very different environment, you have to be operationally focused. So I think firms that emerge that say, yes, we have to do operations and we have to be directed from day one. We have these playbooks and we know they're going to work. So from day one, we have value creation plans and we make sure they get executed. I also think PE can take some lessons from VC because if you look at the vast majority of private equity websites, it's a pitch book for LPs. You know, you get a picture of the team who are all very smartly dressed and well educated, and you get an idea of what their portfolio is, and then you'll get historicals. You'll get their past returns from their previous funds. So it's a pitch book for LPs, and I think they're missing a big trick. And what VC does well, if you look at a lot of VC websites like Andreessen or 20 VC, they will say, look, we're half investment firm, half media firm. And I think that's important. So that attracts building a brand. It's important for every business to build a brand, and it's important for PE firms to build a brand. So if you take that approach and say, look, of course, we're half investment firm because that's our business, but we're going to evolve and be half media. So what that means is, we might do podcasts. We're going to publish a lot more. We're going to open the curtains of PE and we're going to show, look, here's what we do. Here are our companies, meet our CEOs, understand how we've made these CEOs successful. Like here's what's gone right. Even better if they even share, here's what didn't work out. Those are the better stories. Here's what didn't work out and here's what we learned from it. So there's a big opportunity to get really better at that. Because if you do that, you'll attract more CEOs. You'll get, I think, more companies. If you ask a company now, a lot of companies have the aspiration to be bought by PE. But if you ask the average company, who'd you like to buy you, they'll probably only be able to name the top 5 PE firms. They'll probably say, oh, Blackstone, Carlyle, KKR, Apollo. It's very unlikely those funds are going to buy you, right? And there are 6,000 funds in the US. So what happens is you set yourself up for sale, and then you meet these PE firms for the first time. It's all cold introductions, and you go for dinner with them, and you do mutual diligence, and you try to figure out, do I like this firm? Are they going to be good partners for me? Much easier if you've heard about them before. Much easier if they've already built a brand for themselves and they've already built a brand to show we are really partner friendly because really founder friendly because there's 50 interviews now with founders, good interviews, podcasts like this, talking about what went wrong, what didn't go particularly well. So I think being transparent, that's the other issue. There's peace, it's a very shrouded industry and people think there's a lot of secret sauce in PE. There really isn't. There's nothing to really guard. The playbooks, there's no secret sauce in the playbooks. So I think being open about that and building a brand for yourself creates a ton of trust. I think when you get in these auctions, it definitely breaks the tie if the founder's heard of you. It also creates demand because you'll probably get more founders coming to you before they go to an investment bank and say, look, I'm at this stage thinking of selling. Can we talk? So I think it also creates good deal origination. So I think that's what, if a P firm is doing it right, that's what they look like in 10 years. They're operationally focused. They look more like a media firm. They're a lot more transparent and they build a great brand for themselves.
I love that answer. I really do. I mean, it's one of the things to be fully transparent about, why we started this podcast. I have just learned so much more than I had imagined, but that is also knowledge that I can now share as part of my brand or part of what we do, and it has helped our company take shape. And I think that that's really important. And so I, as someone who is like taken that strategy on that you just shared,
Yeah.
I can attest to the fact that it's a win-win, I think, for everyone, in on the show. Yeah.
And look, it's never been easier than today, right? And I think if you are authentic and you are transparent and you put yourself out there, you can build big audiences fast and good things happen. And it also builds serendipity. You meet people that come from nowhere, or you get leads that you weren't expecting, or you get business opportunities that you weren't expecting. It's not that hard to do to build a brand anymore. You put yourself out there, you put the work in, you build the content, you put the content out there, and good things happen.
Yeah, I mean, even Andreessen, they're on all the time. I mean, I've watched their videos. Yeah, and I think that you had a really great point, which is you can either go after the LPs and really have like a push, or you can create a pulling effect where you can pull LPs in from all the amazing entrepreneurial or business owner in the PE world talent, and like dangle this talent in front of the LPs, right?
Yeah,
So I think you're onto something, and I think that your observation of the industry and like just the investment world, I think is really spot on. So, Lee, thank you so much for being here and being part of the show.
pleasure. Thank you very much.
Visit us at LeaderbookAI. Your support as a subscriber means the world to us. So thank you for tuning in. I'm Felicia Shakiba. Let's connect on LinkedIn.